what started out as, okay, great, well, everything but that can work, has become, actually, no, maybe not everything but that can work. We may be facing a situation where revenue growth at least peaked as of the fourth quarter of 2025. And maybe we see a slight deceleration in revenue growth emerging in 2026. A lot of that is because of tech. Will these companies actually be able to produce the top line growth that is necessary in order to ultimately pay back this sort of accumulated cost of investment?
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're catching up with Gina Martin Adams. Gina is the Chief Market Strategist at HB Wealth. I've known Gina a number of years. She used to come up to Boston when I was at Fidelity, and we always look forward to her meetings, which provided a very quantitative lens with which to evaluate broad market conditions, macroeconomic conditions, but also technical and momentum conditions. And I always appreciated how she was able to connect the big picture, the macro, the non-technical with price and price action and investor psychology and the technical. I hope you find a little mix of both here. We're going to lean a lot on the macroeconomic given the conditions here, but talking a lot about sector rotation, about leadership shifts, about an over-concentrated benchmark, and some of the key risks she sees on the horizon. So please enjoy this conversation with Gina Martin Adams of HB Wealth. Super excited to be catching up here again today with Gina Martin Adams. Gina's the Chief Market Strategist at HB Wealth. Gina, pleasure to see you again. How are things these days, okay?
Great, thank you. Really good to see you as well. Thanks for having me.
Yeah, no, it was great to catch up with you in Tampa at the CMT Association event. That was a really cool event, but I was glad you and I had a chance to chat and set the stage for this conversation we're gonna have here. So, I mean, set the table for this meal we're gonna have together, if you could. 2026 has felt like a structural shift in so many ways, market-wise. Leadership has started to evolve. It feels like conditions have evolved. And I think a lot of investors are struggling with, and it's so funny. I can't remember a time maybe where, and you can correct me, where it's felt like you can make very bullish and very bearish arguments and somehow be able to draw on something to back that up. Does
Yeah.
that seem right to you? I mean, are we at a conflicted kind of juxtaposition here?
Yeah, I think that that's a pretty apt description. I think that there's a lot of anxiety right now
Yeah,
because the market internals have shifted around so much, right? And
yeah.
what we had as really consistent long-term leadership in large cap growth is no longer leadership. And what started out as, okay, great, well, everything but that can work, has become, actually, no, maybe not everything but that can work. And we're becoming more and more selective, is the way that I see it over time,
Mm.
as we sort of isolate the opportunities inside the index more finely, as opposed to just buy everything that is not large cap growth, large cap tech, which had clearly reached some sort of major peak in terms of optimism as of October of last year.
So a number of good points we could dig into a little bit further. You'd mentioned, I think a lot of people disoriented by the fact that I was taught a bull market, or at least my experience, a bull market is just going to be large cap growth working, and everything else gonna,
Yeah.
I guess it doesn't really matter, right? It's all about that. Now that that's shifted, there is that period, really fourth quarter of last year into the beginning of this year, where a bunch of other things look remarkably strong, and some of the cyclical sectors and everything. A lot of those things are kind of traditional late cycle leadership, right? Things like
Yeah.
energy and even into consumer staples now. Do you draw, I mean, is there a conclusion to be drawn from the fact that we've rotated to those particular types of leadership? Should that be a cause for concern? Or is that just a normal, healthy rotation that should happen in a bull market?
It's too early to say.
Yeah.
To be completely honest with you, I think that so far it looks like a relatively healthy rotation, though. One of the things that I was noting early in the rotation is it's really rare that you have energy and materials working at the same time that you have consumer stocks working. That is
Yeah.
odd.
Yeah.
If energy and materials are going to continue to work, it's evidence usually of some degree of inflation pressure emerging, some degree of commodity price pressure emerging, and those fundamental conditions are usually pretty terrible conditions for consumer stocks
Yeah.
to work.
Yeah.
Now, what we've seen inside the market is consumer discretionary stocks really starting to turn over and consumer staple stocks performing a little bit better. I would say that's more consistent, right? It's more of a defensive trade, sheltering the broader risks that tend to emerge in an environment in which inflation is accelerating. So I think that we're starting to rationalize that story a little bit. What is very rare to see, though, is consumer staples leading an up market. And I think that this is something that we fail to appreciate is if you're really bullish on consumer staples, that usually means you're pretty bearish on the broad market. That is the rational trading environment is consumer
Yeah.
staples just don't lead an up market.
Yes.
And so if consumer staples keep gathering momentum here, I would argue that that is more bearish than many people are suggesting.
Hmm.
Um, it probably will result in greater breakdowns in other segments if consumer staples are performing that well, because it usually is evidence of a defensive bias that's starting to emerge. It's very early to say that, though.
Yeah.
I think, we're sitting here in the middle of February, and you oftentimes see the fundamentals break down a little bit, or the market trade break down a little bit into March and April. Those are historically pretty weak months. You're coming out of earnings season. We're moving into a seasonally uncertain period, and I don't want to extrapolate too much from the market signals to date.
It's hard not to overreact to short-term movements, right? I mean, I feel
Yeah.
like that's the nature of it. But legendary technical analyst Alan Shaw, who ran the group at Smith Barney for a number of years, he would say, when the going gets tough, the tough get eating, smoking, and drinking. And
Yeah.
that's sort of that impressive performance we've seen from consumer staples, certainly, right, argues for that defensive shift. What can you, and I'd love to dig into a lot of these points a little bit further, Gina. You mentioned particularly earnings. And when I think about you and your work, you've done a lot of really great work about earnings revisions, and just how to think about it. It feels like to me, as we're kind of winding down this current earnings season, it feels like an important one to sort of understand inflationary pressures, potential tariff impacts, and all of that.
Yeah.
What did you hear in this earnings season? What surprised you or did not surprise you? And how should that inform our thoughts about the markets here in the coming months?
Yeah, by far, the biggest thing that shifted during earnings season is the outlook.
Yeah.
I think a lot of analysts will point to we had a great earnings season. Fourth quarter earnings were stronger than we've seen in several years, about 14% earnings growth in the fourth quarter. But what really struck me is in the environment in which earnings outperformed expectations in the fourth quarter, analysts actually marked down their forecast for 2026
Hmm.
growth. And so it looks like, at least right now, we may be facing a situation where revenue growth at least peaked as of the fourth quarter of 2025. And maybe we see a
Hmm.
slight deceleration in revenue growth emerging in 2026. A lot of that is because of tech and what's happening in large cap growth, which is just these impossible comparisons. I mean, they had just extraordinary growth for the last 3 years. We are not likely to see tech growing 25 to 30% into perpetuity. The
Yeah.
problem I think the market faces is that's effectively what we priced. And so we've got to rationalize our expectations for tech. We've also got to rationalize our expectations for the rest of the market, though,
Hmm.
too. While tech expectations became really, really high, and tech companies are saying, hey, we're going to grow, but it's going to cost us a little bit. We're also going to have to spend a whole lot. We're probably going to have to borrow money in order to continue growing. And those are the questions that are starting to emerge inside tech.
Yeah.
The rest of the index, as I mentioned at the onset, had gone through this short-term period of saying, everything's going to get better for us too in 2026. We're going to see fiscal spending, sort of the fiscal spending of 2025, the tax reform of
Yeah.
2025 is going to hit us in 2026. We're going to see the monetary policy cuts or the Fed's reduction in interest rates in 2025. That'll also hit in 2026. So everything's going to be great for everybody. And that was really reflected in the consensus expectations at the start of this year.
Yeah.
And now we're starting to see a little bit of rationalization in that. We're starting to see some pullback in those expectations, in particular on the revenue lines. It doesn't mean that, all is lost, all hope is lost. It just means not everybody can have their cake and eat it too. It means we're going to have to distinguish a little bit more. And I think that's a process that the market is going through so far. So that's my biggest take from the earnings season. I think large cap tech really set the stage.
Yeah.
And then the rest of the index constituents are kind of following along with, okay, maybe things aren't idyllic in 2026,
Yeah.
and we have a little bit trickier climate to invest in than we had hoped.
With AI in particular, right? And the conference you and I attended in Tampa last month, this ended up being sort of a recurring theme, just, the impact of AI and outlooks and everything. Since that conference, I feel like AI related names have been in a bit of a free fall for what it's worth.
Yep.
But there's a lot of discussion, and I'm curious on your take. And I think actually in the panel you sat on, you made the point about mega cap technology and communications names going from very cash rich, we've got unlimited amounts of cash to spend on this, to all of a
Yes.
sudden borrowing aggressively. Like Meta was an example of that, just all of a sudden going into borrowing mode. I mean, how big of an issue is that? Because that it certainly seems to me that that's a shift in terms of these big mega cap names with plenty of cash to throw at something like this, versus we're borrowing aggressively for the opportunity to make these future profits that still haven't materialized. How
Yeah.
big of an issue is that? And do you think it's reasonable that the staggering amounts that have been invested do turn into revenues? How does that look? I mean, what does that look like? What's the bull case look like, I guess?
Yeah, so the biggest problem I think we face is one of expectations. It's
Yeah,
the fact that large cap growth stocks are trading at 6 times sales. So your price to sales ratio for
that's
large cap
bad,
growth
right?
is
Is that what you're
6
telling me?
times. Yeah. That says we have priced extraordinary growth into the long-term future for large cap growth. And a lot of that is concentrated in tech, communications, or what I would call tech's peripheral industries. So it's mostly tech, communications, and then the few consumer discretionary stocks that are tech light stocks,
Hmm,
like stocks. It's not entirely there though, because if you look at the price to sales ratio for Russell 1000 value stocks, it also is at an all-time high at 2 times. So
interesting.
we have gone through a process of saying, okay, we're going to see explosive growth. That's going to be explosive top line growth. That's going to be explosive for growth stocks in particular, but also some value stocks. And that I
Mm,
think is tricky for the market for the companies themselves to sustain into the long term. Now, to answer your question more directly, how big of a problem is this sort of capex story in tech, the debt story in tech? I think it's a story about how to rate these stocks, which were
mm,
traditionally incredible cash flow generators, did not need to borrowed because it was cheap to borrow, and then put a bunch of cash on their balance sheet, maybe send it back to shareholders. Um, Now they do need to borrow. Many of them, anyway, do need to borrow in order to sustain capital spending plans going into the future. That capital spending, provided it actually pays off, will more than pay for all the debt that they ultimately have to take on.
mm.
But we don't know if it's going to pay off. And that's the big question that we have to go through over the next several years is, will these companies actually be able to produce the top line growth that is necessary in order to ultimately pay back this sort of accumulated cost of investment, right? Are we going to constantly see elevated ROE in an environment in which they're borrowing more money in
Yeah,
order to spend more money? And nobody knows this answer for sure. What I will say is, in the past, what we've seen is these really big productivity booms in the United States do not necessarily result in a material shift to long-term revenue growth.
right.
And I think we are now pricing as though that will emerge. And the proof will be in the pudding, so to speak. We will need to see that proof emerge over the course of 2026 to 27, 28, where revenue growth does take a material step higher for most sectors in the US large cap index in order to sustain or in order to justify current valuations. Because what valuations are telling you is that we are going to see a material change in the outlook, and it's only going to get much, much better. Is
Right.
that the case? Historically, that's been really tough to prove. So I think that's what the market is sort of grappling with at this moment in time is, can we really experience an environment of much greater than long-term average growth to justify these prices. And I'm open to the idea that we could.
Mm.
Certainly, there are a lot of bulls out there that are making this story that we will. Long-term history would tell you that is less likely, but who knows? Maybe this time really is different.
I feel like a number of people have made, and it feels like comparisons to the dot-com bubble,
Yeah,
comparisons to like 2007, 2008. It depends on how bearish you are, right? It's very easy to
yeah.
sort of make that. This is the most obvious bubble ever because look at all of this. I mean, can you give us a sense based on what you've seen in your study of market history? How would you make that comparison? I mean, is that an apples to apples comparison? Is that so dramatically different that that's cherry picking two
Yeah.
different eras, unreasonably so?
There are some justified reasons for comparing to that era. There
Yeah.
are some very not even close sort of metrics. I think the justified reason, and frankly, the scariest chart that I've seen is that price to sales ratio that I told you about. Because price
Yeah.
to sales for the Russell 1000 growth is even higher than it was at the peak in the dot-com bubble. So our anticipated revenue growth for growth companies is even stronger than it was at the peak of the stock market in 2000. That's a scary number. And
Yeah.
that's why people are saying, look, this looks a lot like the tech bubble because fundamentally we are pricing growth stocks in particular at much higher multiples than we have in the past.
Mm.
On a sales ratio, on a price to earnings basis, that is not the case. And I know that we're both technicians. I'm spending a lot of time talking about valuation ratios, but I think it's important for context, right? Because prices have driven those valuation ratios to these new highs. And eventually we do need to see fundamentals catch up to support what has emerged in price, right? Or we have a big dislocation to worry about. But nonetheless, price to sales says, yeah, this is a bigger bubble than even the tech bubble was for large cap growth. Price to earnings ratios do not say that story. And this
Mm.
goes right back to what we were talking about earlier, because this is about how much those companies were able to translate that top line revenue growth into earnings. They were able to see explosive margins because they had such strong cash flow growth and they were not reliant upon debt. They were investing, but they were growing faster than they were investing. Therefore, they could ultimately produce much stronger earnings growth than the market had anticipated. And as a result, price to earnings ratios are still not as high as they were in the tech bubble. So we're producing earnings. We're not necessarily growing faster to produce those earnings. We
Mm.
are borrowing at very, very low rates. We're paying less in taxes. We're spending a little bit less, right? We're much more efficient and productive. So that tells you where the weaknesses potentially are here. We have to grow faster and we have to keep sustaining that margin growth in
Right.
order to justify price performance. The other thing that I think is entirely different than the tech bubble is this concentration story. There was no concentration risk in the tech bubble. And the reason being because the tech bubble was about everybody loving all stocks, certainly loving the tech stocks the most, but really all stocks were beloved in the tech bubble. This time, it's about everybody really loving select stocks the most. And so those select stocks getting bigger and bigger and bigger, driving more and more of the market's gains, also driving more growth themselves to justify the concentration of capital in those stocks. So those are two very different conditions.
Yeah.
I do not think there is broad, vast enthusiasm for equities. And we see that certainly in small caps.
Right.
I just don't even talk about small caps anymore. Nobody cares. They've done really well in fits and starts, but they just have not done great, right?
Yeah.
Also, non-domestic equities have done really well over the last year. We're starting to talk about them again, but really we concentrated all of our bets in the equity market on select names inside the US equity market for the most part. This is not the entire story, but relative to the tech bubble, that's most certainly been the story this time around. And it creates this abnormality that we all kind of struggle to really capture. What does it mean? Because when the top 10 stocks aren't working, we don't know what that looks like because the last 5 years has been about the top 10 stocks. But that's not the tech bubble characteristics. So I think there are differences, certainly. And frankly, stocks have a lot more competition this time around. I was in the
Mm,
market, I'm ashamed to say, but nonetheless, in 1998 to 2000, and I remember that was it. Everybody wanted to own equities. Equities were the primary portfolio asset of choice. Today, investors talk to me about the metals, they talk about equities, they talk
mm,
about crypto, we talk about private credit, private equity. These are none of these things were competitive for investor attention in the late 1990s tech bubble. It was
yeah,
really just stocks and stocks alone,
yeah,
at least from my recollection. And so I think that that's also very different.
yeah.
Is we our attention is much more scattered, and there are a lot of other areas that have been exciting places to invest this time around.
Yeah. Don't be ashamed to admit your amazing experience in the financial industry, Gina. Be proud of that for sure, because I think we're about the same. We've had the same similar tenure. But it's funny. I remember setting up a Daytech online account. That's dating us because it was the
Okay.
fastest. And I remember day trading it. I wasn't doing it to trade metals or crypto, which was non-existent. It was to trade technology. I mean, that was the thing. That was
Yep.
your option. And ETFs weren't around or widely available to access some of those other markets. So you're right. I
Right.
think just the options that individual investors, certainly and advisors have now, probably are cup runneth over. I don't know if that's necessarily a good or a bad thing at some point. So with small caps in particular, you mentioned small caps, and I don't disagree. I feel like the return of small caps has been announced with great fanfare and then quietly put away a number of
Yep.
times here. What would it take for small caps to finally be a viable area to focus in? I mean, one thing that comes to mind, rates starting to come down as bonds are rallying here. I mean, lower rates would be part of that, I would guess. But what would it take in your mind to think, okay, this is really the time when we need to be focusing on small caps? Because that hasn't happened yet.
Yep. I think for small caps to work, you need Main Street to work, and that's not in a
Yeah.
period. We have not been in a robust economic growth period. We've not been in a period of time in which you actually get real revenue and earnings growth distributed across industries because we've had a robust economic improvement. Instead, we've had a very narrow improvement in the economy focused on AI and tech investment that has benefit the tech stocks and the tech stocks alone. So one of the things that could really benefit small caps is if AI proves to be the growth engine that many people think it may be, that it helps improve outcomes for corporate profitability across a broad distribution of sectors and industries, small caps may be the biggest beneficiaries of that.
Mm,
If tax reform from last year and monetary policy reductions from last year do prove to be catalysts for broader economic growth, then small caps probably do perform better because that's not the environment we've been in. Frankly, since the pandemic, we've just been in an environment of very, very slow to middling growth off and on repeat. And that was still the
mm,
case last year. As much as many people want to tell me that 2025 was a great, robust growth year, it was a terrible first half and a better second half. And net, still slow growth. So we're still not getting that big economic boost that is normally necessary for small cap stocks to perform well. And that's because small caps are much more levered to the domestic economy.
mm,
40% of large cap growth comes from outside of the United States. That's where all their sales go. Small caps are not even close to that. Most of them are importers and they're ultimately more domestically oriented. So we need to
mm,
see broader economic conditions improve. Some of that is the AI story broadens out. Profits have been very captured in tech and AI specific companies for the last 3 years. We're now starting to see signs that profitability improves for the rest of the index. Profitability may improve for small caps in particular. If that's the case, then small caps could be off to the races. I
mm,
think the market has tried to price this in late 2024 as well. If you remember, late 2024 into early 2025, small caps were also on a tear. It ultimately proved to be short-lived.
yeah.
So those of us that have, touched this flame before are a little bit skittish, but nonetheless, let's hope that this is the time that sticks. But I think it'll
Yeah.
depend upon whether or not we actually get distribution of gains
Mm.
across the index. One thing I don't like right now that I say that I think is a little bit worrisome is the fact that financials are underperforming in large caps. It would be rare for small caps to sustain long-term outperformance in an environment where financials as a sector are not performing well. And we've all talked about tech, but the worst performing sector in the large cap index so far this year is financials.
Yeah.
And so we need to see financials performance improve to really solidify small caps state. It's not just about tech, I guess is the story there is
Yeah.
we've got to see something from financials and at least some stability there.
Hope for small cap outperformance springs eternal, I guess, Gina, at this
Yeah.
point, but we're still waiting. You mentioned financials, and when I'm thinking about what has changed from sort of third, fourth quarter of last year to now the beginning of 2026, financials looked remarkably strong, right? Going into like August, September, October, ended up being a really strong part of the market.
Mhm.
Now, a lot of the big banks, a lot of the regional banks, which actually started to look quite promising, a lot of those are starting to come down a little bit. Why is it so important? I mean, I would agree with you about how that shift can be meaningful. Why is it so important to be tracking financials? What does the weakness in financials tell you about conditions here in
Yeah.
February of 26?
So they're especially important for small caps because they're a larger market cap share of small caps than they
Yeah.
are of large caps, right? But why are they an important tell for the markets at large? Because they're the center of lending still.
Mm,
And they are also the representation of what's going on in the yield curve. So I think the reason that financials sort of have pulled back in large cap is several fold. First, the Fed stopped easing.
yeah.
That's never so easy for financials, where the yield curve steepening that had emerged with the short end going lower is basically stalled because the
Yeah.
Fed stopped easing policy. So that results in some slowdown. Secondarily, financials face a policy problem, because remember, coming into this year, we were going to have a big deregulatory backdrop that emerged that helped support financials. And then all of a sudden, we get the president talking about how credit card rates need to come down. And he's going to mandatorily sort of legislate credit card rates. That's obviously really difficult for profitability of financials. And then the third thing that I think is really weighing on financials is the market has this idea that there are fintech companies that are inside financials. Those fintech companies are also somewhat trapped in the AI trade,
Yeah.
potentially could be displaced to some degree by AI, or at least that's the language of the market that has emerged. And to the degree that AI is extremely disruptive to the technology companies that are inside the financial sector, that could be problematic. So those are the three
Mm,
things that I think are weighing on financials. They're a broader tell for the market because they're the center of lending activity. And generally, as economic conditions are improving, companies are their confidence is rising. They go out and they borrow more in order to spend more. So you and develop this self-fulfilling economic cycle. And financials are usually at the forefront of that because they are the ones that are funding that growth. Some would argue that that chain has been broken because so much of lending goes outside the traditional banking sector now.
mm.
But nonetheless, that's the historical relationship. So they do matter. And I think they're important to watch. In particular, I am mostly watching that AI component that we talked about. The policy framework is the winds are going to change repeatedly, but the degree to which AI really impacts outcome in financials, I think, is the one key aspect that we really want to be on top of in 2026.
Great points all around, Gina. You'd mentioned economic growth, and this is another one. And again, I feel like it's so easy for people to make a what appears to be a very rational argument that the economy is just incredibly strong and we just don't see it, versus others saying there's so much internal weakness. How can you not see it? We're both unable to see the other side of it. When you look at economic conditions, I guess for my viewers and listeners who are who feel the economy is this big complex thing they'll never understand,
Yeah.
can you boil it down to a data point or two? What are the most important data points that tell you things are great or things are not great, and particularly looking for, like, what's that thing we should be looking for that will help us try to get a sense of what's actually going on?
Okay. I would say first and foremost, the way that the economy translates into market outcomes inside the equity market is through earnings. So you really
Mm,
only need to know how companies are doing inside that economy.
Yeah.
And that makes it a lot easier as an equity analyst to just point directly to corporate earnings trends. And my first line of defense suggesting the economy was not that strong is the fact that tech sector earnings growth was 20%. Outside of the tech sector, we had sub 5% earnings growth for the last 3 years. Something's wrong there. It is not a solid economy, right? That is a really big gap between tech sector growth and rest of economy growth. By the way, that rest of economy outside of tech on average produces somewhere around 11% growth per year. So to have closer to 3% growth per year on average up until 2025, that's really slow growth. And we started to see that those segments improve a touch in the second half of 2025, including small caps, but also large caps outside of tech. We've started to see those earnings lines improving, suggesting a broadening of earnings growth, which would support this notion that maybe the economy is finally reaching some kind of liftoff.
Yeah.
We'll see. Again, reserve judgment for a longer term sort of duration of improvement. But nonetheless, that's the first thing. I do have a very short list of economic indicators that matter because I've created my own economic cycle model that gives us a sense of where we are in the cycle at any given point in time and what it might mean for potential returns. And so I could tell you offhand, my favorite indicators are sort of a composite of consumer sentiment, which has unfortunately been just stuck near all-time low levels for the duration. It started to improve a little bit, but consumers are not happy. Also, business sentiment in the form of the ISM manufacturing survey. That also has improved a little bit, but it's been kind of stuck in the doldrums for much of the last few years. And then capacity utilization, which really gives us a sense of how the industrial machine is running, and continuing claims as my primary job market indicator. So those four I rely on very, very heavily. It sounds a bit wonky, but nonetheless, I put them into my own model to give me a sense of where we are in the economic cycle. Those four indicators, by the way, have also given us great signals for the equity market performance at large, because when they're doing really, really poorly, operating as though the economy is in recession, you tend to have your best forward-looking equity market returns. And when they're doing really great, you tend to start to get worried about, we can't get much better than this. Are we going to start to see this ship tip over? So we're going from a period of extraordinary weakness in those indicators, which has allowed us to produce very strong equity market returns, to middle of the roadish lately.
Got it.
Maybe we're starting to get to liftoff. But there's a lot of room to improve still before we get to full liftoff on those indicators.
It's fantastic, Gina. Last question then. I feel like I've called you a technical analyst longer than you have yourself. You used to have the disclaimer, I'm not a technical analyst, but then you would very beautifully explain some very thorough and thoughtful technical concepts. So I appreciate you embracing that. Combine the two for us, right? I mean, so given that shift in your economic model, from a technical perspective, breadth conditions remain quite strong. Even with big tech struggling, there are plenty of things in industrials and energy and materials and staples doing remarkably well here. How do you reconcile what you're seeing in the economic model versus what you're seeing from the markets themselves, with the S&P, for now, still holding up okay?
Yeah. So what I see in the economic model is oddly really consistent with that, right? Because when we were sitting kind of in this middle of the road phase where we couldn't get any liftoff, and now we're starting to get some liftoff in the economic model. That's consistent with some liftoff in all of these left behind industries and sectors that really just didn't contribute much to the market performance in those years when we were in economic disarray. So in that sense, it does kind of match. Again, the trick with the S&P 500 is really constituents, though. So when you're in a period of time where 40% of the S&P 500 is tech and tech alone, and tech experiences an explosion in growth, you naturally have really great performance. That's the period of time we just came off of.
Yeah.
Now we're moving into a broader market, but it may actually be accompanied by slower market returns. Even as the economy improves, what's good for Main Street's not always good for Wall Street. But as the economy improves, you expect the distribution of earnings growth to broaden out. That may leave tech in the back seat. Tech's still 40% of the index by itself if it's slowing down its growth pace, it becomes this big drag on the index, and the rest of the index does great. It can only make up so much. That's kind of what we're seeing right now.
Yeah.
You've got double-digit returns in energy and material stocks, but those little engines are just not enough to make up for the losses that we've experienced in financials and tech. And so that constituent bias can be very, very meaningful at certain times. I think that's probably going to be the state of affairs for much of 2026, is this broad market looks like the duck that's doing nothing on the top of the paddling at the top of the pond, right? The duck looks very calm, and underneath his feet are just moving like this because the broad market underneath that headline is just churning like crazy. And there's so
Yeah.
many interesting things happening. But here we are sitting at the S&P 500 up basically zero so far this year. It's like nothing has happened. And yet sector dispersion has widened out. We've seen a tremendous improvement in certain sectors and deterioration in others. We're seeing small caps perform reasonably well. Non-domestic stocks are on fire. So there's a lot happening, and yet our little duck, the S&P 500, looks like he's just skimming along the surface, doing nothing. And I think that that might be the characteristic that is 2026, as we see this broadening in the economy, as we see other items suddenly, other investment opportunities suddenly emerge. We might see the big cap index, which has been such an exciting place to be for the last 3 years, kind of go nowhere.
Gina, I've done a number of interviews over the year. That might be the first waterfowl analogy. That's pretty awesome.
Yeah.
Well done. I
Okay,
like
great.
that though.
You know, I'm
And
happy
it's
to be the first.
no,
Kind of.
but it's funny, right? I mean, I 100% agree, right? There's such a weight in the big technology names that, and we're seeing that so far in 2026. A weak tech sector, remarkable strength in cyclical sectors nets out to a perfectly flat S&P. This was a lot to think about, Gina. I've always gained so much from our conversations, and today was no different. Thanks for giving us some time today, and we'll look forward to having you again on very soon.
Well, that's great. Thank you so much for having me. I learned as well from you always, for decades now. So please keep the lines of communication open. I'm happy to have those tips whenever I can get them. But thank you very, very much for having me. I really did appreciate the conversation.
Thanks again to Gina Martin Adams of HB Wealth joining us on the podcast today. Some really good thoughts in there all around. What I've always thought about Gina's work, she sort of combines fundamental and technical, macro and micro, good assessment of broad market conditions, but also always has some really good insights about earnings and earnings revisions. Couple things I just want to highlight out of our conversation. She mentioned the valuations, right? And I made a point of asking Gina because I feel like Gina always has a really good, finger on the pulse of the markets through data. It's a very data-driven process, and it strikes me that in February of 2026, I'm getting people that are, bright in the face telling me how obviously market conditions are great. And then I've got other people telling me how obviously this is a huge bubble that's unwinding. I've got some people telling me the economy is super strong, and others telling me the economy is so obviously weak. And I thought Gina's comments, along those lines were really helpful. Really thinking about the strength in technology and how that's dominating or has dominated, sort of justification for the market in a primary uptrend. That rotation away from those things, I think is pretty meaningful. Great thoughts about valuations and particularly price to sales ratios being at extreme levels. Again, I think valuations are one of those that I've heard people use valuations to argue different sides of things pretty often, but I really trust and appreciate Gina's perspective there. That duck analogy is a really good one. I like that one. I don't know if I've heard that one before, right? About above the water, it looks like the duck's just kind of coasting along, but underneath there's all this going on. I've heard that analogy used for other things, but for this market, I think that's a really apt way to describe things. And that's the sense you get from the strength in some of these other areas of the market, cyclical areas, even some of the defensive areas here in February 2026. I hope you caught her description of her proprietary models. Gina's always done a great job, creating and managing proprietary models to think about different market conditions, whether it's with earnings and earnings revisions and navigating through earnings season, whether it's through macro data and her perspective on sentiment, consumer sentiment, business sentiment, jobs data, and all of that, getting the sense that was pretty negative, but now starting to improve a bit. I thought was pretty interesting to hear as well. Really enjoyed talking with Gina, by the way, at the end of earnings season, because I thought it would be helpful to get her take on what we heard. And I really especially appreciate that thought about, what's the best way to evaluate economic conditions, right? What's the way to really understand what's happening with the economy? And her answer was, look at earnings. And so, her take on earnings here was basically companies downgrading their expectations for 2026. So I think between the Fed lowering rates, it promises to be continue to be an eventful 2026. But I appreciate Gina's take on all of those things above and much, much more. And I'll look forward to having her back on the show later this year to see how those expectations may have changed. Hopefully we'll get her to share any updates on her different model-related work to see what has shifted as this midterm election year progresses. Thanks again to Gina Martin Adams. By the way, she has a great newsletter that's really designed for financial advisors, individual investors. You can find that at hbwealth.com. That's a newsletter that Gina and her team put out. Can't recommend her and her work enough. It's fantastic, and I've enjoyed following it for many, many years. Encourage you to check it out. By the way, if you want to learn more about the technical types of things that I will be using, and that I know Gina and others will be using to understand that relationship between earnings expectations, between this over-concentrated benchmark, and connecting that to what's actually happening in the markets, I think great market awareness comes with a good, disciplined process of evaluating charts. And I'm happy to teach you what I do and what others do to successfully improve their situational awareness for the markets. 3 great benefits to our premium memberships at Market Misbehavior. First off, virtual courses. I'll teach you all about technical analysis and behavioral biases. Second, our member-only reports like our weekly flight plan and our monthly chart review and our 2026 market outlook, which so far has proven pretty good about the leadership rotation and improvement in cyclical sectors and defensive areas of the market. Finally, full and immediate access to our member community where you can ask questions, where you can learn from other like-minded investors, and have me supporting you and encouraging you all along the way. All of that can be yours today if you go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today here on the Market Misbehavior podcast. Thanks for watching. Thanks for listening. We'll be back again soon. In the meantime, remember, it's always a good time to own good charts.